In this video, I'm covering journal entries, and this is part 2. There's another video, journal entries part 1, that has more information. There's also a worksheet you can download that goes along with the video from helpmelearnthis.com. There's more information on that in the description to the video on YouTube. When journalizing transactions, you need to know the side the account increases on, and this is called the normal balance. Every account will have a normal balance. To help me remember this, I use debt and curls. Debt accounts increase on the debit side, and they are your expenses, assets, and dividends. So these accounts have a normal balance of a debit. Your curls accounts increase on the credit side, and they are your unearned revenue, revenues, liabilities, and shareholders' equity. So these accounts have a normal balance of a credit. So we're going to journalize transactions for Angie's kids. And the first one says, on January 5th, the company paid $115 for the month's electric bill. This would be paying the electric bill would be for an expense. Expenses increase on the debit side. So on January 5th, the company would debit utilities expense for $115. And the company is paying the $115. So that means that they're paying out cash. Their cash account will decrease. Cash is an asset, increases on the debit side. So when the company pays out cash, they're going to decrease the cash account, so they credit the account. So cash is credited for $115. Problem 2 says, on January 11th, the company purchased $250 in craft supplies from Michael's on account. So the company's purchasing craft supplies. So they're going to receive these supplies. Supplies are an asset, so they increase on the debit side. So on January 11th, the company would debit craft supplies for $250. At the time of the purchase, they're making the purchase on account. That means they're using credit. So at the time of the purchase, they're not actually paying for the supplies. They're incurring a liability. It would be accounts payable is the type of liability. Liabilities increase on the credit side. So they would credit accounts payable for $250. And then the third problem says, on January 15th, the company paid $200 for the laptop and printer previously purchased with a note. So the key here is it says it's previously purchased. So on January 15th, they're not actually purchasing the laptop and printer. They've already purchased the equipment. When they had made that purchase, they used a note. They incurred a liability. So now they're paying against the liability. When they incurred the liability, they would have credited it because liabilities have a normal balance of a credit. When they pay down the liability, they're going to debit. So on January 15th, they're going to debit notes payable for $200. And since they're paying, that means they're using cash. Cash is an asset. It has a normal balance of a debit. When they pay cash out of the organization, when they decrease the cash account, they credit cash. So cash is credited for $200. Problem 4 says, on January 3rd, the company billed customers $500 for services provided. They're billing their customers, so that means that they're not receiving payment at the time of the journal entry. When they bill customers, they're going to debit an asset account called accounts receivable. So on January 23rd, accounts receivable is debited for $500. This is the account used when credit is extended to customers. And then it says that services have been provided. When the company provides services to the customers, they're earning revenue. Revenue has a normal balance of a credit, so revenue would be credited for $500. And then problem number 5. It says on January 30th, the company paid $50 for supplies previously purchased on account. And the words to pay attention here are previously purchased. So on January 30th, they're not purchasing supplies. They've already purchased the supplies. When they made that purchase, they purchased them on account. Now they're paying down. That means they incurred a liability. So now they're paying down that liability. And it would have been accounts payable. So liabilities have a normal balance of a credit. So when they pay down a liability, they debit the liability. So accounts payable would be debited for $50. And then it says that they're paying. So that means that they're using cash. And cash is going out, so it's going to decrease the cash account. Cash is an asset, has a normal balance of a debit. So when cash is decreased, you credit. So cash is credited for $50. Problem 6 says, on February 4th, the company paid $500 for 1 month's rent. This would be an expense. Expenses have a normal balance of a debit. So on February 4th, the company debits rent expense for $500. And it says that they paid that $500. Again, so they're using cash. Cash is an asset, has a normal balance of a debit. When the company pays out cash, they decrease the cash account, so the cash account is credited. Problem 7 says, company received $175 in cash from customers for services provided. So on February 12th, the company is receiving cash from their customers. Cash is an asset, so it has a normal balance of a debit. So on February 12th, the company is going to debit cash for $175. And it says they're receiving this cash for services provided. The company has provided services. This means that they've earned revenue. Revenue has a normal balance of a credit, so the company would credit revenue for $175. And then problem 8 says, on February 24th, the company paid $150 in wages to employees. This would be an expense. So on February 24th, expenses have a normal balance of a debit. So on February 24th, the company would debit wage expense for $150. And since they're paying the employees, that means cash is going out. It's going to decrease the cash account. Cash, again, is an asset. It has a normal balance of a debit. So when cash is paid out of the organization, when cash decreases, when the cash account is decreased, you credit the account. So it's credited for $150. And then problem 9 says, on February 27th, the company received $135 in cash from customers previously billed. So the company's receiving $135 in cash. So it's going to increase the cash account. You increase the cash account by debiting the account. So on February 27th, cash is debited for $135. It says that they're receiving cash from customers they previously billed. When they previously billed the customers, they would have debited accounts receivable, which is an asset. And now that the customers are paying, it's going to decrease that account. It's going to decrease accounts receivable. So accounts receivable is an asset, has a normal balance of a debit. To decrease the account, you credit it. So accounts receivable is credited for $135. I hope you found this video helpful. There's more videos, worksheets, and study guides at helpmelearnthis.com. Thank you for watching.